Hello, everyone, and welcome to another installment of Investing with IBD, the podcast. It's Justin Nielsen here, your host, and joining me as he does every week is Arusha Peiris. He is an O'Neil Global Advisors portfolio manager. How are you doing, Arusha?
I'm doing well, Justin. Well as you could be with this little tough market day, I should say, right?
A little pullback that kind of turned into something bigger for some stocks.
Yeah.
And certainly one of the things that we'll be covering, of course, this is April 5th, Wednesday, April 5th, that we're talking about and taping today. We'll be dropping this tomorrow. But helping us kind of decipher all of this is going to be David Chung. He is Deputy Markets Editor at Investors Business Daily. Gosh, David, we've been colleagues for 20 years now, 20 years plus. So
sounds right.
It's getting up there. So welcome back to the show, David.
Hey, really glad to be back. And the last time I was here, it was just you and me, Justin. So it was great to have Arusha join us, and great to see both of you.
Yeah, I don't know what it was that scared Arusha off by your last appearance. I think it was because you were talking about Fed and 1994. That was enough to scare anyone off.
For sure.
But the last big Fed tightening cycle. So
exactly.
we'll definitely have a quick little recap of that because it's interesting what's happened since you were on last, David. So I think it's definitely worth talking a little bit about that. But of course, we'll also talk about the markets. David's going to show us some stocks that are on his watch list, even though, again, it's been a little bit tough out there. And, I was off last week because I was in Hawaii with the family. It was spring break. My daughter turned 18. We were also doing a tour of the University of Hawaii, which my daughter might become a rainbow warrior next year. So we'll see about that. But we had to acknowledge an important milestone that occurred while I was on vacation, and that is Bill O'Neil, the founder of Investors Business Daily. It was his 90th birthday while I was out. So we want to acknowledge that. And so who better than to have David Chung on, who authored a wonderful book, The Making of Millionaires, the IBD story, to talk about some of the things that he's learned from Bill over the years. I'm sure Arusha and I will be able to pipe in with some stories as well, but just want to acknowledge the founder of Investors Business Daily and a man who certainly has changed a lot of lives in the investing world. So with that, let's get right into it. How about we pull up the market? Do you want to start with the NASDAQ composite, David, or the S&P 500? What's your poison?
Hey, I'd like to order you're presenting. Let's definitely start with the NASDAQ, guys.
Okay, so what's your take here? I mean, you look at the indexes, and I mean, earlier this week, okay, we had a little bit of a pullback, but I mean, it was really inside that strong Friday that we had, March 31st. It was the end of the quarter, end of the month, end of actually a pretty phenomenal quarter when you think about it. How much the NASDAQ was up, even though it had that really rough period in February. A little bit of a banking crisis in there. It's still pretty amazing how far it had recovered for that first quarter. But man, we've given up a lot of ground here, especially today, even though those first 2 weeks were kind of very tight, very inside. What's your take here now, David?
Well, right now, I even after today's decline, guys, to me, there's no question that the leading index for 2023 continues to be that NASDAQ. Even after this 1% drop, and it's most likely a distribution day, that would only be one distribution since the follow-through that we covered in IBD March 29th. And, we still have something like a 15% gain year to date. You annualize that, it could be a pretty darn good return, right?
Right.
Annualized.
David.
Right. Well, thank you. Well, here's Bill O'Neil maybe rubbing off on me, guys. And
ever the optimist.
Right. And also, right. I'm glad you mentioned the book that I wrote, because it's brings back a lot of good memories. And hopefully, in the episode today, we'll give you a little bit of the inside story behind that book, which is the inside story of the founding of IBD. Right. So I think that I think there's still reasons to be bullish in the stock market. It's just that we have some serious walls of worry, right, to climb. And I think the economic data probably shook some weaker investors out today.
Mm-hmm.
Yeah, and so, well, Justin, and I'll just add one thing here. So Justin, you mentioned that it was a big down day. It's funny. It's, I thought it was a big down day too, because of my
like a big down day in the individual stocks
coming down.
I'm with you guys there too. Absolutely.
But when you look at the NASDAQ itself, it ended up closing down only a little bit more than 1%. And it looks like we might have gotten a distribution day, maybe just slightly higher. And so the indexes might have masked some of the selling that was going on. But the reality is that so far it's been a narrow rally. Most of the stocks that did sell off within that narrow rally are still hanging in there. And so hopefully it's more kind of a shaking of the trees than anything else. But it's just crazy when you look at the NASDAQ, as David said, it looks fine. It looks more kind of like a normal pullback than anything else.
Yeah, I would agree, Irusha. And, technically we're above all of the major moving averages that we like to focus on in terms of IBD technical analysis. With 12,000, we finished at 11,996. This is clearly a key psychological level. If we hold around there going into the rest of the week, then to me it feels like there are buyers out there that are trying to maybe take advantage of these pullbacks. Now, if we look at the S&P, clearly the gain is not as strong. And I think we all can understand one reason being the regional banking crisis. And then two, I think it's very important for everyone to keep watching the small caps, because the small caps have clearly underperformed, right? The Russell, we like to look at IWM Russell 2000 ETF, it's down 0.5%. It disappointingly gave back a lot of that nice initial gain in January, February. So it's a mixed market, but for all of us, I don't want to speak on behalf of all three of us, but I think we love to pick stocks, and I think there still are really great stocks to pick.
Since you're kind of going through a lot of the indexes, it's worth mentioning that, again, the S&P 500 was only down less than, what was it, a quarter? It was a 0.25% down today. So
0.25.
not nearly, not nearly as bad. Now, granted, you had some oil stocks that were kind of helping there. The Russell 2000, as you mentioned, it was looking a little bit stronger going into this rally, and certainly seemed like it was participating more. Came down a little bit harder in the last couple of days, but the Dow Jones Industrial Average, which, remember, this is the one that led off the October bottom, it was actually up today. It's been showing kind of some strength. Now, again, it's tricky. This is a price weighted index. There's only 30 stocks. The other day when OPEC Plus, came out with their production cuts, you had Chevron up a decent amount. You had United Health up a lot that particular day, which is a very high price stock. So this is, with a price weighted index, this is having a bigger influence. So again, it seems like there's some of these indexes, some of the weaknesses getting masked by some of the individual stocks.
Let me add something here, going off the weakness. I'll pull up the ETF for the regional banks. Here's KRE, which came pretty close to making a new low today, right? So while, and especially with the NASDAQ, a lot of the performance, or a number of the stock, reason why the Qs especially, I would say, it's hanging there, is because some of those larger cap tech stocks like Apple, Google, actually, Google is also even forming a cup with handle, but those were, they weren't really selling off too much today. But then to the side, you have the KRE starting to sell off a little bit more over the last couple of days. So it could be more, hey, let's hide some money in kind of the larger cap tech stocks and slowly try to get out of other stuff that's already been hit.
Yeah. Well, and it's worth mentioning that QQQ, remember, that is the NASDAQ 100, and the NASDAQ 100 by definition is the top 100 companies in the NASDAQ non-financial. So it's had a little bit more strength here because, hey, you exclude the financial names and the ones that were hit the hardest with that, kind of failures of a few banks and the worries that went along with it, that kind of helped. And so the Qs, those got above their February 2nd highs, whereas none of the other indexes were really able to do that. They kind of came right up to those February 2nd highs, and well, at least the Nasdaq Composite did, and got turned away. The S&P 500 didn't get there, and the Dow and Russell had a ways to go before they got to their February highs. So the Qs were definitely the strongest. But as you mentioned, Arusha, certainly those mega caps are helping in that regard. More to add here, David? Let's turn it back over to you.
Yeah.
You're our guest, and we're, Arusha and I are
just going to say, is David
shutting you out.
Yeah.
No, I was looking forward to a true three-way conversation here on the market.
It's a partnership here.
Yeah, exactly. And one is that is such a great point both you guys are making in terms of, okay, a little bit of buying in blue chips today. It feels like since the second half of 2022, there's so much jitteriness and uncertainty among institutions that there's almost like a daily sector rotation almost. However, that said, your point about the Qs getting above the February to early February highs is also maybe related to the fact that the 10-year bond yield, 0 TNX on Market Smith, continues to fall.
I knew this is what I had up on my Market Smith. I knew
I
this is where
think
we were coming.
Right. Since this podcast is all about the market, not just about stocks or trading, right? I think you cannot analyze the stock market fully without looking at what bonds are doing. It's especially this year, it's stocks versus bonds. And if we see ongoing buying of bonds, the yield as we represent here continues to go down. That actually, in the long term, benefits stocks in two ways. One, the earnings yield for stocks gets more attractive. That encourages more demand for stocks. And two, maybe the strength in the 10-year bond yields, or strength in the buying of the prices, bringing down the yields, helps the regional banks, especially those that have a lot of treasury holdings. It might help stabilize that situation.
That's interesting.
If we have real frenetic volatility in bond prices, I think people would be even more scared to hold banking stocks.
Mm-hmm. Well, and what's interesting here is, okay, look, when we topped out on the yield, okay, so looking at this 0 TNX, the 10-year yield, when we topped out, that was in October.
Right.
That was right around the time that the market was kind of putting in its bottom. So it was kind of this, as the yields were rising, it was putting pressure on the stocks, especially the growth stocks. But now, I mean, here we had a down day for the yields and a down day for the markets. So has the concern shifted away from the inflation part, and now there's more of a fear of the recession and weakness to come, that maybe we don't have inflation to worry about as much. We had a pretty good PCE report that came out Friday, and that again launched the market to a very strong subsequent follow-through day. But now, is it recession fears? Is that what's coming into focus?
Well, I'm not going to answer that because I think that was a perfect rhetorical question.
Okay. Make Arusha answer it.
I think the recession. Yeah, I think that's the case. You're starting because so you are seeing this where now the yields are starting to hit lower lows here. But it's a lot. I'm looking at these staples, right? So the XLP. They're having a pretty amazing run right now. So you have this narrow rally for a number of the tech stocks. You have the larger cap tech stocks having a pretty big influence on the Qs and getting above the highs. So that narrow rally, and then on the other side, you have the staples starting to act pretty well. So, for instance, take a look at Hershey's. Hershey's looks like the greatest stock in the world right now.
Right.
Tasty looking.
I was looking at some breakouts today from Market Smith, and I'm like, oh, what is this? And it was a utility. So I mean, we can pull up the XLU. I mean, the utilities. I mean, again, this is just up to its 200-day moving average line.
You don't want to eat
very
your
strong
chocolate.
day.
Yeah, you don't want to eat your chocolate in the dark, right? So you need that electricity, or
well, and then keep going on with hot tea. And going on off of that tangent, take a look at XLV, because if you eat too much chocolate when it's well lit, you're probably going to need to go to the hospital eventually.
So it all comes full circle. So bottom line, David, to just kind of wrap a bow on this segment, it seems like there's still a little bit of uncertainty out there, as you mentioned. David Ryan certainly has been mentioning on the IBD Live this idea of a trading range potential that we might be in, and it's the jury's still out. So any kind of parting words of wisdom on the market, especially since you are someone who consistently writes the big picture a few times a month at least. I'm not sure what the schedule is exactly. Are you like twice a week normally, or?
Currently once a week. We've expanded the team.
Yeah,
the markets team in general. So we want to give as many market writers that shot at the signature analysis. And to answer your question, Justin, I think just like with what we've been saying on IBD Live, it's important to have some cash to cushion against down days, especially severe down days in your best stocks, because we're seeing that happen on a near daily basis. And but also stay focused on the stocks that are leading year to date, making big gains from their breakout points, because I feel like we're closer to the end of the rate hike cycle, and that's probably a good thing for the stock market. Maybe the recession will be light. Maybe it truly will be just a soft landing, more a soft landing than a hard landing. And because of that, I think focusing on the companies with above average growth will lead to some really good returns.
Very good. Well, when we come back, we're going to talk about some of the inside stories that David gleaned as he was writing his book, and with his decades of experience in the newsroom at Investors Business Daily and with William O'Neil. Stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host, and joining me as he always does, almost always, Arusha Peiris. In fact, he was kind of leading the charge last week while I was on vacation. He's an O'Neil portfolio manager, O'Neil Advisors, Global Advisors portfolio manager. And then we also have David Chung coming to us this week. He is a deputy markets editor at Investors Business Daily, has a lot of years of experience in the newsroom. I think David, you first came to my attention because of your wonderful Investors Corner articles that you were writing.
Thank you.
And you continue to write some of those, and you're the editor, making sure that those Investors Corner education materials get out there for all the world to see. And certainly you had a lot of time in which Bill O'Neil was very, very involved with the market and talking with the markets team regularly, and giving that guidance and instruction on how to phrase things and how to analyze what was happening in the market. So anything that you want to share in particular about kind of that experience?
Thanks, Justin. Yes, and thank you for mentioning the Investors Corner, which now is a team operation in terms of editing. Got to really tip my hat to Juan out in Sibia, who's been with IBD as long as us virtually, and because of my duties with IBD Live Leaderboard, I'm doing less editing, but still always love to get involved. And the Investors Corner is very special in my heart, actually, because there was one day, the first year I joined IBD in 1999, Chris Gessel asked me to come over to Bill's office, which is just around the corner of the newsroom. And Bill said that, we would really like you to manage that column as a front page column. The only story on the front page of Investors Business Daily when it was a daily newspaper, Monday to Friday, as the only educational piece on a page where it was mostly news. So that struck me because he clearly, was following through on a mission to help as many readers as possible just become smarter in the stock market and make more money with a great system.
Yeah, education always so important.
Yeah, I mean,
Absolutely.
I mean, I started out as a subscriber around that time, David, and that was the one column I read every day. I would cut out the columns and kind of read them over and over again, and because there wasn't back then that there wasn't a lot of other ways to learn it, and so yeah, those were just incredibly valuable.
Such a great point, Arusha, in terms of learning, right? Because we had Bill's book, How to Make Money in Stocks, that first edition, I believe it was 1985.
Which was not easy to read, right? I mean, because when you're new to I was completely new to stocks, so to get a book like that, I mean, it was just too much. It was too complicated for me at that time. But getting these kind of bite-size, everyday, real-life examples, that's kind of just how things just slowly built for me.
Absolutely.
And then I go back to the book, and it's like, okay, now that makes a little bit more sense.
I think a lot of people did that. And right now, I think the spirit of the Investors Corner really flows freely through the podcast, IBD Live, so many videos that we produce, the stock market today, and other products, premium products that IBD has grown over the past 2 decades. So even though Investors Corner is now only produce a brand new corner produced only once a week in general, a lot of the content that was produced in the past continues to be republished and still gain a lot of following and really increase a lot of people's knowledge. So I feel as a member of that project, I feel a lot of pride in that. I also want to, since we're going to talk a lot about Bill O'Neil, I wanted to share a few lessons that I learned personally. But before that, I think for someone who's brand new to IBD or has not met Bill O'Neil and wondered, how did IBD become successful? How did Bill O'Neil become so successful? I think you can, in one way, distill it into three key elements. One was you had Bill O'Neil, the scientist, the guy who was curious about how the market worked, created an incredible database that led to a simple to use rating system, EPS rating, relative strength rating, and after the composite rating, and then looking at the charts of the greatest winners and trying to find patterns. That was the scientist part of Bill. Then you had the artist in Bill, in which he looked at these charts so often and he identified these patterns and named some of these patterns, or at least if he wasn't the first to name it, he certainly made it common knowledge within the U.S. investing audience. So cup with handle, flat base, and then after that, the short stroke, the 3 weeks tight, the ascending base. In that sense, I really see Bill as a creative mind. And then the third key would be incredible humility. I think you guys would agree that never once did I ever hear Bill in the newsroom or anywhere boast about himself, like how much money he made, how successful his businesses were. He was always humble, and the system of IBD, the buying and selling, the trading, the investing, has humility through and through. And I think the only time when Bill would boast was when the paper had a milestone, when there was success with the paper because it was helping people.
And usually, I will say that when he boasted, he wasn't saying I, he was saying we. He used we a lot.
That's right.
And instead of I, for the positives and what was going on, and whether it was interviews, whether it was discussions with people, or whether it was speeches he was giving, he definitely focused on the we more than the I.
Absolutely.
And those bullets are I've got to hand it to you, Dave. I think that those are just some really good things, and I feel like there's a lot that we could unpack there. Certainly, I think the scientist part that you mentioned, that curiosity element. And I think the humility to go with it was important, because he kind of approached it as, hey, look, I'm not, I don't think I'm the smartest guy in the room necessarily, but I'm curious to see how this actually works, not just the way people say that it works.
Right.
And so I think he also had that maybe healthy journalistic skepticism of, rather than just accepting what people were saying at face value, well, let me kick the tires on this myself and see if this is actually true, some of these statements. And again, this is, I think, what led him to follow people that were actually successful in the market, as opposed to those that were just writing about it and saying, what the market should do.
Right.
And
Like
let's
the
follow those
Dreyfus
people.
Fund, right?
Yeah, the Dreyfus
Yeah.
one. Let's follow the people, Jack
Exactly.
Dreyfus, who's actually doing it and being successful. Let's figure out what he's doing, as opposed to what people are saying the market should do. Yeah,
absolutely. I'm glad those three basic key points resonated with both you guys, and because I had the true rare privilege to meet with him in person and talk with him, being part of a lot of meetings. Now I wanted to share 5 little mini points, mini lessons that I gained personally through my own interactions. One, and I'll keep them very brief, but the first one is, I think one key to his success was always keeping all the mistakes small in every investment. I know Justin's talked about this, and when Justin, you would examine his trades, you saw lots of tiny losses, and then the big pull, the big winner, the one that made up for all those losses and more. One story that really sticks in my mind is the fact that Bill visited the office of Gerald Loeb, another famous Wall Street investor who avoided the 1929 crash, wrote some great bestsellers, and he asked Gerald Loeb about how he thinks about cutting losses. Do you think 8% is a worthy loss cutting rule? And Gerald Loeb told Bill, well, I would like 8% to be the maximum size loss, not the minimum. And so that was a great story he shared. And I think in times in webinars and in seminars, Bill would say, I would like to keep my losses in general averaging just 4 to 5%. Another moment that was a really great one, sort of a light bulb moment for me, was when I was in the conference room, in the newsroom with Bill and Chris Gessel, and we were just talking about during the 2012 to 2014 part of the market. We came out of the great financial crisis bear market coming out strong, but then we had a lot of choppy action, and there were a lot of stocks that looked great, promising, but they didn't work out. And yet at that time, Bill was really closely examining all of our stories and whether our chart analysis was right and whether we were picking the right stocks to write about. And he said, in general, this year you guys have been doing good work because you selected pretty much stocks 60% of the time that were winners. And in any process, in any system, if you can be right 60% of the time, you can take that to the bank. And so that means that, right, if you keep your mistakes small, and your winners are really going to pay off.
60% is good. I mean, even if you're 40% right, if you manage your risk, right, and you're taking, you're letting your winners run, that a lot of times that's enough.
Exactly. 3 more quick lessons is, one time Bill asked me to bring me a couple charts, print out the charts of the stocks that really were disappointing in my own investing. And I brought CSIQ, that's Canadian Solar. Maybe we can take a look at a monthly chart later, but I invested in that one heavily because Chris Gessel and others and myself, we had some success in some of the true winners of the solar energy space when it really took off. We're talking First Solar, FSLR. Its IPO was incredible. JA Solar was a stock that was a triple for me. So I thought, CSIQ, looking for that another big gain. But when I showed him how I got nicked and bruised by that stock, he said, Dave, look at the price. In general, it's been in the teens. You want to be looking for higher quality, better long-term winners are going to probably start breaking out at a much higher price and just keep going higher. So that lesson about, looking for the truest growth stocks really resonated. Two more lessons that I like to add is that you guys have heard this story, but Bill used to take tennis lessons, and one lesson he learned from the teacher is that after he made a really nice forehand stroke, and he admired it, he made a mistake of not getting ready for the next shot.
That's great. That's so good.
I love that story because I was a competitive, a fairly modest, minimally competitive tennis player in high school, and it's so true. You got to just get ready for that next play, and I think that makes sense in terms of getting ready for the next winning stock in the same sector that you might have had success. So when I think about how he said, well, we did really well in Price Club, but we didn't do as well as we would have liked to in Costco, which came right after that, which integrated. And he said that was an important lesson. And I think today, when you look at Axcelis, ACLS, that was my Costco, because I should have been paying attention to these new emerging winners like ACLS after we've seen some big runs in some of those large cap semi companies, whether it's NVIDIA or ASML or whatnot. And so the fifth lesson is related to this book I wrote about Investors Business Daily and the making of Millionaires. And this was to commemorate the 20th anniversary of IBD. 2004 was an incredibly important year for IBD, because it took 20 years since the 1984 founding for IBD to finally become profitable on its own as a business entity. We finally figured out the formula, so to speak. We had enough sales, advertising was going well, and running the operation well enough that Bill asked me, "Hey, David, could you write a book to commemorate this milestone?" And it's pretty crazy that I wrote this book in a month with the help of.
Wow, no way.
Yeah,
wow.
with the help of then editor-in-chief Wes Mann. He was a great guy. He wrote one key chapter about the editorial section, the development of the editorial side of the newspaper. But the reason I'm bringing up this book is because as we had many conversations with Bill, he had told me that he invested, as we all know, it took two stocks, Pick and Save and Price Club, the profits of those two stocks to generate the money needed to start a newspaper, right? And we all know, okay, well, he invested quite a lot of money over 7.5-year period in Pick and Save, and about 4 years in Price Club, which became Costco. But I don't think he ever told anyone that, and at the time he said, "David, don't write this in a book, don't tell anybody, but I made 25 million in profits from those two stocks, and that 25 million helped me start the newspaper." Wow. And so that was incredible profit he made. And I think the lesson from that is patience and concentration in great companies with a lot of growth. And that lesson, I think, helps every IBD investor if they really want to, find a big winner.
Yeah, so true. And I really like the title of the book, Making a Millionaires, because I worked as Bill's assistant from September of 1999 for 15, 16 years, something like that. And during that time, I mean, I can't tell you how many letters would come in, with people saying, "Hey, you changed my life." People would send, I remember one particular gentleman sent a photo from Arizona, and the license plate said, "Thanks IBD, THX IBD," and it was on his Mercedes. And he was like, I can't believe that I bought a Mercedes with my profits in the stock market. People talking
Fantastic.
about what they were able to do for their families. They're sending their children to college. Charities. There was a pastor who talked about how much money he raised with just charitable causes, and doing good out there, and it was with stock market profits. So again, really love the title of the book. I think it was just very good, because I did see those letters come in. But you had another story that you wanted to share, Dave.
Yeah, your comment, Justin, about the title, It's great. In retrospect, I really agreed with the title, the Making of Millionaires: how IBD rewrote the rules of investing and business news. It's quite a mouthful, but this title was it was formed over many meetings and discussions among a big group, and it kind of reflects the humor of Bill O'Neil, a dry humor, because at the time when I was writing this book, I was thinking about, like, what would be a catchy title, and because California is kind of a place of entrepreneurship and venture capital and startups and all that, I was thinking about how up in Northern California you have that famous Sand Hill Road where a lot of large venture capital firms were made. And I said, well, where's IBD based? We're not based in Northern California. We're not in Silicon Valley. The term Silicon Beach was not invented yet.
Right.
But we're near Ballona Creek. Why don't we call the book The Innovators at Ballona Creek? And so that was my idea, okay, to make it like kind of a curious, like mysterious name. And I presented a Bill, and then a week later, Bill came and said, he knocked on my, he was coming up to my cubicle, got my attention, said, Dave, why would you want to name me after a concrete canal? and it's true that Ballona Creek might sound like very pastoral and beautiful, but that part of the creek, which is the LA River, is not a pretty sight. And I said, well, Bill, not everyone knows what Ballona Creek really looked like, but maybe we could put Ballona Creek on the map. As you can imagine, he got a committee of executives, and that title got shot down so fast.
Yeah.
But The Making of Millionaires rose to the top.
You mentioned that it was for the 20th anniversary of IBD back in 2004. We're coming up on the 40th anniversary next year. Actually, I think April is our anniversary month.
That's right.
This is when the first paper launched. 39 years ago. So we're kind of commemorating that as well. Any chance that you're going to do another edition? The next 20 years?
I would say if you agree to be a co-author, and you too, Rusha.
Okay. Well, we'll have to start our contract negotiations here pretty soon.
Well, and a couple of things here. Well, first, David, I bought that book day one. So I was very excited when you were coming out with it, because that was another opportunity to get knowledge from you and also Bill and the whole IBD team. Awesome. And speaking of anniversaries, this is going to be the 60th anniversary of William O'Neil and Company.
Yes.
So that's what started everything. Bill was doing the William O'Neil and Company, working with institutions at that point, and that really got the whole ball rolling. So,
and let's not forget that as you mentioned, with Price Club and Pick and Save kind of starting up, the profits being used from those to start up IBD, William O'Neil and Company, that was started from Syntax, that had come up with the birth control pill back in the early 60s. Hey, these Mexican yams have something to them that are interesting, and it was a company, I think it was based out of Panama, and and it was really kind of a combination of Chrysler in '62 after the Cuban Missile Crisis, after that got resolved, and then parlaying that into Syntax.
Well, also Corvette too, right?
And Corvette, the short side.
Shorting
Corvette. Yeah. It's amazing. It's amazing what stock profits can do, right? Well, when we come back, we're going to talk about some of the stocks that are on David's radar currently in a very tough and tricky environment. So stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host, and along with Arusha Pires, O'Neil Global Advisors Portfolio Manager. And joining us on this show is David Chung. He is Deputy Markets Editor at Investors Business Daily. Also, he just was giving us some of the inside scoop on writing his book, Making a Millionaires, the IBD story. So that was good to hear, kind of some lessons from William O'Neil, the founder of Investors Business Daily. But now let's talk about some of the stocks. And as we mentioned, as strong as the indexes look, man, some of the individual names got hit pretty hard. But David, what do you have for us? Where do you want to start in terms of some of the stocks that are setting up? We've got ONON holding here. ONON holding. The ticker symbol is ONON. The shoe company. This is one that had such a phenomenal move from its last earnings report, and Leaderboard,
Right.
of course, caught that move with an earnings option play. This is one you were talking about, a little bit of a short stroke, something that you're very familiar with from your Investors Corner articles. You want to
Right.
kind of give us a little bit of insight into that short stroke and what you're seeing here?
Absolutely. Well, this is a very rare pattern that that doesn't have a 100% guarantee of success, but we really like the way in the prior week how the stock gave up so little of the gains that it produced on that earnings. You can see it was nearly a 46% gain for one single week. Most stocks dream of that kind of gain for a whole year. So when you had that big move in heavy volume following just a wonderful report of earnings and sales growth, what Bill O'Neil discovered is that once in a while you can see the stock trade very, very tightly right after that big up week, and normally volume will really dry up, which would indicate that there's so few people willing to sell even after that big gain. And the price activity during that short stroke week is so tight that Bill O'Neil came up with that term, a short stroke, like the short stroke of a little pen. So what you're looking for is extreme price tightness in the week following that big earnings inspired gap up. Now, what we like to do is sort of compare the swing from the low to high in that short stroke week with that prior big up week, and it was a quite a big ratio in this case, nearly 8-1 in terms of that big up week, and then the short stroke. Not quite as tight as what was really the gold standard for this particular pattern produced by Research in Motion more than 16, 17, 18 years ago. It had a huge earnings inspired move, 57% gain in 1 week. And then in the next week, the swing between low to high was only 5%. So in other words, the swing in that big up week versus the swing in the following short stroke week was more than 11-1. That is extremely rare, and I want to reiterate that as we can see now, because of a downgrade today by a certain research analyst, probably based purely on valuation, that knocked the stock for a loop this past week. You can see that the stock tried to clear that buy point around 32. Now it's at 29. It forced us to modify the position in Leaderboard. However, the stock is still holding on to more than the lion's share of those gains. So we would think that just the fact that this was a failed breakout from this new entry point doesn't mean that there will not be any future entry points in the future. This is a stock that's really turned around after a severe decline during the bear market, and we would expect either a new base to form, maybe an eventual test of that 10-week moving average, which is that red line on the Marcus Smith chart that we have right there. And given the unique qualities of this stock and the company, given the fact that a lot of big winners can't come from the retail sector, we think the probabilities are strong that this could produce some future big moves.
Mm-hmm. And Arusha, just since we have MarketSmith up, for those that are watching the video, you can find that on www.investors.com/podcast. Maybe you could pull up BB real quick. You mentioned Research in Motion. Now ticker symbol is BB, BlackBerry on that one. If you go to 2009, I'm sorry, not 2009, 2004.
2004. There we go.
Yeah, but yeah, you see that short stroke right there, and yeah, exactly as you described there, David. It was up 50% in a single week and just didn't give up any ground, and it just went up very strongly from there. Now, of course, this was in a very strong bull market as well. We had the 2003 bottom, follow through day there, and you also had this other stock coming out at the time when a perfect cup with handle, Apple Computer, as it was known at that time, coming out of that cup with handle. So the start of something great there. But back to the present and on. Any other comments on this one? Now, one of the things we've been talking about is we certainly have not only the model book, of Research in Motion, but we have a number of shoe companies, whether it's LA Gear from the 80s and Reebok when the aerobics craze was kind of coming along, Crocs in the aughts, and the big move it had, Skechers. What is it about shoe companies that sometimes just can have such dramatic moves like this, David?
It's amazing how shoes are a staple, right? And yet fads and trends and innovations make the new stocks in this area very attractive and very dynamic. And I think I've heard Arusha talk a lot about how he's always interested in those companies that can command more market share, high prices for their goods, because and which boosts those profit margins and those earnings, which allows them then to further expand, whether it's geographically or a new product category. And it seems like ON has that potential to do what other companies that you mentioned, Justin, have done in the past. So it is amazing. There's a parallel with the beverage industry too, right? And there have been some amazing growth stories there as the nature of beverages change. So one thing that we learned this week, thanks to a fellow O'Neil Global Advisors portfolio manager with Arusha, is that the success of ON is related to the fact that in the city, a lot of people like their shoes not only just to wear to work because they look good with their outfits, but then they can go outside and walk a couple miles in those same shoes and have a great workout. And so that kind of versatility plus style and fashion is compelling. And then you've also got them winning a lot of eyeballs through social media, and the fact that Roger Federer, former world #1 tennis player, is a big backer of the company makes you think, wow, well, are they going to revolutionize tennis and other sports in terms of their footwear? It's, to me personally, a stock to really, really learn a lot about, both not just a chart, but also the company itself.
Yeah. Well, well, they do look, they're unique looking, right? So,
and you have a pair right there, Arusha.
I have a pair of them, and I think a lot of people these days have a, or it is kind of the thing to get. They're really just comfortable, so I had to try them, and I was pretty impressed with them. But they're not cheap by any stretch. But it is kind of that unique look with the little holes in them, adding the cushion and stuff like that. And so I think when I got it a while back, immediately I started thinking about this stock, and I do own some shares of it. But thinking about all those stocks that you mentioned, David, the LA Gear, Reebok, Crocs, Deckers, Skechers, right? Nike, of course. So it always seems, and it goes back to Bill, where I think I remember reading, maybe it was in your book, David, but every bull market, there always seems to be a shoe company that does well. a new shoe
Right.
companies.
Yeah, the leisure. So also, it just kind of in a related thing, retail is something that always captured Bill's attention. And the next stock that you have for us, David, is MercadoLibre in the retail area. Now, this is in the internet space, Latin American company, and ticker symbol MELI. What can you tell
That's
us
right.
about MercadoLibre?
Well, very briefly, I want to say that this is a company that is not really inventing the wheel in terms of e-commerce, right? You've got Amazon, or not reinventing the wheel in terms of financial payments. You've got PayPal and other fintech companies, but they seem to be number one or among the top in a variety of those kind of categories, whether it's e-commerce, whether it's payments, and now small lending. And it seems to me that uh, they are helping fuel growth in Latin America. And the chart, if you look at even that weekly chart, shows how the stock has that ability to make some really nice moves after breakouts. We've had a major correction, but so have a lot of other high growth stocks since that November 2021 peak. And so I think for those reasons, the this stock has gotten a spot in leaderboard, which is a handpicked list of CanSlim quality stocks, and it has to go through a lot of hoops just to even be considered. So for that reason, I think this is a really interesting company, especially given that last year a lot of people were pounding the table on Wall Street to look beyond the U.S. and look for growth in Latin America.
Mm-hmm. Now, with the concern that was coming for a while there on PE ratios, and especially money flowing away from things with high PE ratios, is that a concern with this one? Now, this doesn't have a 3 or 5 year growth rate, so part of that is that it's recently kind of gotten into that profitable area. You see that there's some NAs
Right.
there, and if you look at the annual earnings per share, you can see that 2019, 2020, 2018 were all negative in the EPS. So this is turning around, and I mean the estimates are pretty impressive
It's
too.
huge,
61% and 50% for 2023 and 2024 respectively. So does any of that factor into your analysis?
Oh, absolutely. And, I'm sure this is not the first time on this podcast we've talked about high PE stocks. And that really that makes this company truly unique, right? There probably would be a lot of people scratching their head about why would we highlight a company with 136 times trailing 12-month earnings. And we have to acknowledge the fact that the company so far has put up some incredible numbers on the top line and the bottom line. It's rare you're going to find any company in any stock screen at IBD or outside IBD that has revenue growing at 40, 50, 60% quarter after quarter after quarter. And then look at those strong earnings per share estimates, as you pointed out, Justin. I think the fact that when you're going from possibly from $9.57 last year to $15 and then $23, there's something special, really special going on here. And I think it relates to the fact that the company is succeeding, going beyond just their initial operation, which was being sort of like the Amazon of its region.
Right. Now, no conversation would be complete without a mention of a semiconductor stock. So maybe we can end this with Rambus. Now, of course, a lot of attention on NVIDIA and AMD and all the silicon carbide stocks. What is it about Rambus in the semiconductor fabless space that is attracting your attention here, David?
Well, to be very brief, I have to admit that I don't know as much about Rambus at this point as some of the other leaders in the semi space, but fellow colleague Ken Shreve has highlighted the fact that this company is really firing on all cylinders regarding data center chips. And if we think about how AI is probably going to demand more usage and capacity in the data center, that it seems like Rambus's technology is going to benefit and gonna continue to see even more demand. Look at first of all those earnings estimates. Look at the strength of the recent uptrend, which is a lot stronger since the second half of 2022 than it was in, say, 2019, before the pandemic bear market, in 2020, after that bear market ended, and even in 2021. So I think technically this is really an interesting company turning around its earnings. You see that earnings did fall year over year. And it's probably because they're reinvesting into new growth areas. And you have a chart that's one of the strongest today. So I would not be chasing this stock at this point, because you got to be disciplined with your buy points. But right now, I think this stock is showing a lot of strong institutional demand, and if you don't have that strong institutional buying, you're less likely going to see a true market leader emerge.
Mm-hmm. And of course, we can't ignore the fact that, as you mentioned, I mean, this is definitely a leader. That relative strength line is just, it's really rocking. The outperformance versus the S&P 500 is pretty remarkable since since that low that we had back in October. Well, hey, Dave, a pleasure to have you on, as always. And of course, for those of you that are wanting to see more of Dave, you can catch not only his big picture writing throughout the paper, but also he is a frequent contributor to IBD Live. So if you haven't checked that out, you might want to go to www.investors.com/IBD Live to kind of check out the market analysis that we do every day, starting 10 minutes before the market open and going a full hour and a half. So Dave is constantly a number of times a week, he's hosting that, kind of driving the train, asking a lot of good questions of the hosts, not the hosts, the guests that we have on, including David Ryan every week. So a lot of great stuff there. So David, I appreciate your contributions today.
Hey, Justin, it was a blast, and Arusha, same to you. It was really great to be part of this talk, and I'm wishing everyone success in this year. I think there's a lot of opportunity, and if we look at what happened in 1995 after the end of a lot of rate hikes by Greenspan, 1994 to 1995, we had a really strong market. Maybe perhaps we're getting closer and closer to that cycle again.
Yeah, no, absolutely. Well, thanks again, Dave. And thank you, Arusha, for joining me as you do every week. Now, you're not going to be with us next week, right? You're going to be off.
I'll be in New York and Boston visiting clients for William O'Neil.
Okay, so there's that whole other job that you have.
That's right.
But we will miss you. But we are going to have Dan Fitzpatrick from Stock Market Mentor. He's going to be on the show, returning. Always a great conversation with Dan. So we can't wait for that, and we hope you join us. Thanks for watching us this week, and we'll see you next time. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.